Hey, what's going on? So, based on the general consensus from everybody, it looks like we're going to do this kind of like we did the banking changes. We're going to break it down and look at this brick by brick, as someone would say. So, we're going to look at NSCC 803, and this video pertains to mitigation, specifically fire sale risk mitigation and liquidity drain mitigation. And it's actually a good thing that we're going to do this section by section because the whole filing is actually outlined by sections grouped into categories. So we're just going to go ahead and tackle this category in this video, mitigation. Now, the first one is fire sale risk mitigation. So in addition to creating capital efficiency opportunities for market participants, NSCC believes that broadening the scope of central clearing at NSCC to SFTs would also reduce the potential for market disruption from fire sales. Now, fire sales, in regards to what they're talking about, in the case of securities lending, the primary risk of fire sales relates to the reinvestment of cash collateral by institutional firms that are the lenders in securities lending transactions. Basically, they're talking about rehypothecation. They say those institutional firms will typically reinvest the cash collateral they receive from the borrower into other securities. So basically, they're taking the collateral or the borrowed securities, and they're taking those borrowed securities and they reinvest those borrowed securities into other securities. So they then go on to say if they then default in that specific situation, which is likely happening throughout the market, the institutional firm lenders generally need to quickly liquidate the securities representing their reinvestment in order to raise cash to purchase the originally lent security. In other words, they have to sell other parts of their portfolio to raise the cash or capital needed to go into the market and buy back those shorts, fail to delivers, things aforementioned at the beginning of this filing. So a substantial number of disconnected and competing liquidations by multiple lenders can create fire sale conditions for the securities being liquidated, which can harm not only the institutional firm lenders by potentially lowering the amount of cash they can raise in the sale of securities, but also can create market losses for all holders of such securities. So again, mitigation. When you're mitigating something, it means you're trying to lessen the impact of something. So like, I don't know, I'm trying to give a real life example. If you've ever played the Pokemon video game, there's like an attack, I think by like the rock Pokemon called Mitigate. Basically increases your defense. Just think of it like defense. Yeah, no, I'm a freaking nerd. Who cares? Anyways, moreover, if an institutional firm lender should default and fail to return the cash collateral back to its borrowers, the borrowers would typically be looking to liquidate the borrowed securities in order to make themselves whole for the cash collateral they delivered to the institutional firm lender. Competing and disconnected sales of such securities could similarly create fire sale conditions and not only harm the borrowers to the extent the venue of securities decline, but also create market losses for all holders of the borrowed securities again. So basically what they're saying, fire sale risk primarily comes from the rehypothecation of collateral in a typical securities lending transaction. And in a normal scenario, these are typically done by broker dealers outside of the NSCC. So basically they're trying to consolidate everything through the NSCC. And if you do not go to the NSCC, which is what we talked about last time, the capital efficiency opportunities, you're not going to be able to claim that as net. It's going to have to be gross, which could in turn result in this fire sale possibility happening, which they clearly outline so far. So each section kind of flows into the next so far, which is pretty cool. You don't typically see that. So basically, if a borrower goes tits up and they're caught in this situation where they've borrowed securities that have been basically reborrowed, quick liquidations must happen, and they will be facilitated in this scenario by the NSCC. And they'll have to go and buy the originally lent security through the market. Now, summary of fire sale risk mitigation. NFT is proposing to be the new. I put NFT. That's where my brain's at. in NSCC, not NFT. NSCC is proposing to be the new securities lending central counterparty, as they should have already been. The NSCC is aware that the primary risk of fire sale stems from the rehypothecation of securities in the form of collateral through securities lending. So in the event of a default, NSCC can now quickly liquidate the SFT positions, which will basically protect the broader market from crashing when liquidations occur on mass scale. So basically, they're preventing the dominoes from falling too fast to destroy everything. So this is like very, very much so some confirmation bias as far as this filing so far. Now, first, it says right here in this top paragraph, in the event of a default, NSCC would conduct a centralized, orderly liquidation of the defaulter's SFT positions. Such an organized liquidation should result in substantially less price depreciation and market disruption than multiple independent, non-defaulting parties racing against one another to liquidate their positions. Remember, the exit. Everyone's going to be trying to get out of that exit. So they're saying basically when everyone tries to rush and cover or deliver or what have you, we're going to make it to where the dominoes fall a little bit slower so we can control the situation a little bit more as far as the impact of the overall market. So this could be a best case scenario situation because, while the market is a very obviously gray area of a place to be, I wouldn't necessarily call it free whatsoever. There's a lot of room for loopholes and things like that. So far, this is tightening all those up, and the NSCC is very aware of, I think, of the scale of just what is out there as far as bad collateral. So let's take a look at the liquidity drain risk mitigation real quick. Liquidity risk may also arise if, in the context of a stressed market scenario, borrowers or lenders concerned about their counterparties' creditworthiness seek to unwind their securities lending transactions and obtain the return of their cash collateral or securities. Think of it like a bank run as far as within the securities lending market. So, if they see this stuff starting to fall, like things are starting to sell off, they may make a run. They may try and go make a run and demand that their cash collateral be returned for the securities. That may not be able to happen in the event that everyone's being defaulted left and right and liquidated left and right. So that is, again, while the previous mitigations were set up, goes hand in hand with this. It says this occurred to a certain extent in 2008 when borrowers began demanding to return borrowed securities in exchange for the cash collateral the borrowers had posted to institutional firm lenders. These runs may require institutional firm lenders to quickly sell off securities that are the subject of their cash reinvestments to raise cash to return to the borrowers, thereby also creating potential fire sale conditions with respect to the reinvestment securities, as described above. Similarly, borrowers may need to purchase or reborrow, why couldn't they just say purchase, securities in stressed market conditions leading to potentially significant losses. Melvin. NSCC believes that having SFTs be centrally cleared by NSCC would lower the risk of a liquidity drain in a stress scenario. Specifically, NSCC believes that having it clear SFT activity would provide confidence to borrowers and lenders that they will receive back their cash. Therefore, if you go through us, the NSCC, and have us clear your securities lending transactions and you don't go through these poopy broker dealers, we're going to guarantee you and provide you with confidence that you're going to get that cash back in the event you want to come and get your cash back. Broker dealers may not be the case, and they're outlining this right now. So it's like the NSCC lending market versus this corrupt, one that's in place now by these broker dealers. So by having a firm grip on what collateral is good versus bad, and by having these over-leveraged Fs with rehypothecated garbage being required to report under gross, not net, as mentioned in the previous video, it Fs the shorts because it Fs the shorts and FTDs or people holding them because, again, if you don't claim those payables and receivables as netted, you cannot reduce your capital requirements, meaning you have to report it as gross, which can in turn get your ass defaulted by the NSCC. Damn, this is crazy.